April 25, 1938. Newton, Massachusetts. A child is born who will one day turn mathematics into the greatest money-making machine Wall Street has ever seen. His name is James Harris Simons, and he will achieve something no investor in history has matched. From 1988 to 2018, his flagship fund will return an average of 66% annually before fees. That is not a typo. 66%. Every single year. For 3 decades. Warren Buffett averaged 20%. George Soros averaged 30%. Jim Simons nearly tripled them both. By the time of his death in May 2024 at age 86, he had accumulated over $31 billion. But here is what makes his story truly extraordinary. He did it all with math. No gut instinct, no insider information, no charismatic stock picking. Just pure mathematics, computer algorithms, and a revolutionary belief that patterns hidden in market data could predict the future. This is the story of how a shy mathematician who once failed as a stockroom clerk became the most successful hedge fund manager of all time. Young Jim Simons was not your typical kid. While other children played outside, he would sit for hours doubling numbers in his head. 2, 4, 8, 16, 32, 64, 128. On and on until the numbers became impossibly large. He pondered Zeno's paradox, the ancient Greek puzzle about how motion is possible if you must always travel half the remaining distance. Most kids his age worried about baseball cards. Jim worried about infinity. He was born into a modest Jewish family in Newton, Massachusetts. His father Matthew owned a shoe factory. His mother Marcia was a homemaker. They were not wealthy, but they valued education intensely. They encouraged their only child's endless questions and his obsession with numbers. By high school, Jim was winning math competitions and earning scholarships. When he was 14, he got a summer job at a garden supply store. They put him in the basement stockroom. His job was simple. Receive merchandise, remember where it went, retrieve it when needed. Jim was terrible at it. He could not remember where anything was stored. The owners moved him from the stockroom to floor sweeping. He loved sweeping. It was easy, required no memory, left his mind free to think about mathematics. At the end of summer, his supervisors asked about his plans. Jim told them he intended to study mathematics at the Massachusetts Institute of Technology. They laughed. The kid who could not remember where the sheep manure went was going to MIT. That seemed like the funniest thing they had ever heard. But Jim Simons was not joking. In 1955, at age 17, he entered MIT. He did not just attend MIT, he devoured it. Mathematics was not work for him, it was oxygen. He loved everything about it. The logic, the elegance, the way complex problems yielded to patient analysis. He finished the 4-year program in 3 years, graduating with a bachelor degree in mathematics in 1958. Most students would celebrate. Jim Simons decided to ride a motor scooter from Boston to Bogota, Colombia with friends from MIT. They traveled through the United States, Mexico, Central America. When they needed a place to sleep, they asked local police if they could stay in jail cells for safety. It was adventure for adventure's sake, the kind of thing a young mathematician does when he is brilliant enough not to worry about his future. After his South American odyssey, Simons headed to the University of California, Berkeley for doctoral studies. He was 23 when he earned his Ph.D. in mathematics in 1961, focusing on differential geometry, the study of curved spaces. His thesis advisor was Bertram Costant, a renowned mathematician. Simons' thesis was titled on the transitivity of holonomy systems. It was dense, abstract, beautiful work that only a handful of people on Earth could fully understand. The early 1960s were a time of Cold War paranoia and technological race between superpowers. The United States government was desperately seeking brilliant minds to break Soviet codes. In 1964, the Institute for Defense Analyses hired Jim Simons as a code breaker. The deal was perfect for a young mathematician. He could spend half his time cracking Russian codes and half his time on his own mathematical research. The pay was excellent, far better than academic salaries. And his mathematics started going very well during this period. He was developing ideas that would later transform physics. But Chern-Simons had a stubborn streak. He believed deeply in certain principles and was not afraid to speak out. In 1967, General Maxwell Taylor, who oversaw the Institute for Defense Analyses, wrote an article in the New York Times magazine strongly supporting the Vietnam War. Simons was opposed to the war. He published a counter-editorial, also in the Times, stating that not everyone who worked for Taylor shared his views. A Newsweek reporter noticed and asked for an interview. During that conversation, Simons laid out his plan. While the war continued, he intended to spend 100% of his time on his own mathematics, not the government's code-breaking work. When the article appeared, Simons was fired. He was 29 years old, jobless, but strangely unbothered. Mathematics was his true calling anyway. Almost immediately, he received an offer that would change his life. Stony Brook University, part of the State University of New York system, asked him to chair their mathematics department. The university was still relatively new and wanted to build a world-class math program. Simons was young, only 30, but he had vision. From 1968 to 1978, he transformed Stony Brook into one of the premier mathematics departments in the country. He recruited brilliant faculty, created an environment where research flourished, and continued his own work in differential geometry. During this period, Simons collaborated with the legendary mathematician Chern. Together they developed what became known as the Chern-Simons form, a geometric measurement that proved crucial not just in mathematics but in theoretical physics. Years later, physicists working on string theory realized that Chern-Simons theory provided the mathematical framework they needed. Simons did not know physics then and admitted he still does not understand physics deeply. But his pure mathematical work became foundational to understanding the universe. A framed copy of the Chern-Simons equation hung on his office wall for the rest of his life. When asked to explain it to lay people, he would smile and say he could explain it to someone, but not many people. This was Chern-Simons' specialty. He saw patterns and structures invisible to others. In pure mathematics, this ability earned him prestigious awards. In finance, it would earn him $100 billion. The shift from academia to investing was not sudden. Throughout the 1970s, while still teaching, Simons started thinking seriously about financial markets. Could mathematics be applied to predict price movements? Most investors relied on fundamentals, studying companies, analyzing industries, predicting economic trends. Some used technical analysis, studying price charts for patterns. Simons wondered if there was a third way. Pure data analysis. Mathematical models. Algorithms that could detect patterns humans could not see. In 1978, at age 40, Chern-Simons made a decision that shocked the academic world. He left Stony Brook University to start a hedge fund. His friends thought he was crazy. He was at the peak of his academic career, respected worldwide, doing important work. Why throw it away to chase money on Wall Street? But Simons was not chasing money, not exactly. He was chasing an intellectual puzzle. He believed markets had patterns. He believed mathematics could find those patterns. He wanted to test the theory. He founded a firm called Monometrics in Setauket, New York, just east of Stony Brook. His early approach was to trade commodities like currencies and commodity futures based on fundamental analysis. He would study supply and demand, economic indicators, then make bets. But he found the experience gut-wrenching. The emotional roller coaster of watching positions move against you was unbearable. Simons did not trust intuition, his or anyone else's. He needed something more reliable. He turned to his network of mathematicians and former colleagues from his code-breaking days. He brought in Leonard Baum, a cryptanalyst from the Institute for Defense Analyses who had co-authored the Baum-Welsh algorithm, a mathematical tool used in speech recognition. Baum's specialty was using mathematical models to find patterns in data. Could the same approach work in markets? The early models were primitive by later standards, but they showed promise. Baum developed algorithms to trade currencies based on statistical patterns. The models worked, sort of. They made money, but not consistently. The problem was that financial data is incredibly noisy. Markets are influenced by millions of factors: human emotions, news events, economic policies, random fluctuations. Finding real patterns buried in that noise was extraordinarily difficult. When Baum eventually abandoned mathematical modeling and returned to fundamental trading, Simons did not give up. He recruited James Axe, an algebraist from Cornell University whom he had personally convinced to join the Stony Brook faculty years earlier. Axe was brilliant, creative, and shared Simons' vision. He expanded Baum's models to cover not just currencies but any commodity future. Gradually, they were building something. By 1982, Simons changed the firm's name from Monometrics to Renaissance Technologies. The name was deliberate. He wanted to signal an intellectual renaissance in finance, bringing scientific rigor to an industry dominated by gut instinct and old boys networks. Renaissance was not located in Manhattan near Wall Street. It was based in East Setauket, Long Island, on a 50-acre campus that looked more like a university than a hedge fund. This was intentional. Simons wanted to attract a certain type of person. Throughout the 1980s, Axe and his team of researchers improved their models. They used mathematical techniques to explore correlations in market data. The approach was simple in concept but fiendishly difficult in execution. Gather massive amounts of historical price data. Use statistical methods to identify patterns. Build mathematical models that predict when those patterns will repeat. Execute trades automatically based on model signals. Never override the model with human judgment. Simons called it systematic trading. Others would later call it quantitative investing or algorithmic trading. Simons did not care what it was called. He cared whether it worked. In 1988, Renaissance established a new fund called the Medallion Fund. The name honored the mathematics awards that Simons and Axe had won earlier in their careers. The Medallion Fund would become the crown jewel of Renaissance Technologies and arguably the most successful investment fund in history. The initial results were promising but not spectacular. The fund made money, but so did many hedge funds during the bull market of the late 80s. What made Medallion different was not the size of returns, it was the consistency. While other funds had wild swings, Medallion chugged along steadily. Month after month, small gains accumulated. There were losing months, of course, but far fewer than chance would predict. By the early 1990s, something remarkable was happening. Medallion was posting annual returns of 30, 40, sometimes 50%. And these were not lucky years. The fund made money in good markets and bad, in bull runs and crashes. How was this possible? The secret lay in Simons' hiring philosophy. Unlike every other hedge fund on Wall Street, Renaissance did not recruit from business schools or investment banks. Simons refused to hire people with traditional finance backgrounds. Instead, he sought mathematicians, physicists, computer scientists, even astronomers. He wanted people who understood data, algorithms, and statistical analysis. He wanted people who could build and improve complex mathematical models. He wanted people who checked their egos at the door and let the data speak. In 1993, Simons made a pivotal decision. He closed the Medallion Fund to outside investors. From that point forward, only Renaissance employees and their families could invest in Medallion. This seems counterintuitive. Why turn away billions in outside capital when you are posting incredible returns? Simons understood something crucial about his strategy. The more money Medallion managed, the harder it would be to generate high returns. The fund's edge came from exploiting small, short-term inefficiencies in markets. If Medallion grew too large, its own trades would move markets and eliminate those inefficiencies. By keeping the fund small and employee-owned, Simons could maximize returns without destroying his own strategy. But closing the fund to outsiders had another brilliant effect. It created the ultimate alignment of incentives. Every researcher at Renaissance had their personal wealth invested in Medallion. When the fund did well, they got rich. When it struggled, they felt the pain directly. Simons also dramatically increased the fund's fees. He moved from the standard 5% management fee and 20% performance fee to 5% management and 44% performance fee. A 44% performance fee sounds outrageous. No rational investor would accept such terms. But here is the key. Renaissance employees were not typical investors. They understood the models, believed in the approach, and had seen the results. They gladly paid 44% of gains because even after fees, they were becoming extraordinarily wealthy. The fee structure also served another purpose. It allowed Renaissance to attract and retain top talent. Young researchers could be compensated generously as they took on more responsibility. Senior researchers who retired or left could continue earning from their Medallion investments. It was a closed-loop ecosystem of genius and wealth creation. At the same time as these structural changes, Simons made hiring decisions that would define Renaissance for decades. In the early 1990s, he raided IBM's Thomas J. Watson Research Center, one of the premier corporate research labs in the world. He specifically targeted the speech recognition unit, which was pioneering machine learning techniques. Two of those hires were Robert Mercer and Peter Brown, computational linguists who had been working on algorithms to translate speech to text. Mercer and Brown brought cutting-edge expertise in pattern recognition and machine learning. They would eventually become co-chief executive officers of Renaissance, running the firm after Simons retired. The culture Simons built at Renaissance was unlike anything on Wall Street. There were roughly 150 researchers working on the 50-acre Long Island campus. Half had Ph.D.s in mathematics, physics, computer science, or related fields. This was not a trading floor with shouting brokers and flashing screens. It was more like a university department or research lab. Researchers worked on improving models, testing hypotheses, analyzing data. One mathematician who visited the campus called it the best physics and mathematics department in the world. The difference was that instead of publishing papers, they were making billions. Simons instituted radical transparency within Renaissance. Every meeting was documented. Every decision was explained. Anyone could challenge anyone else's ideas with data and logic. Hierarchy did not matter, evidence did. If a junior researcher found a flaw in a senior researcher's model, the flaw was fixed. Ego was not allowed to override mathematics. This culture was the opposite of typical Wall Street firms where senior traders ruled by intimidation and young analysts were expected to stay quiet. Renaissance also required researchers to sign strict non-disclosure and non-compete agreements. The firm's methods were highly proprietary. If someone left Renaissance, they could not work for a competitor or discuss Renaissance strategies for years. This secrecy frustrated outsiders. How did Medallion consistently beat the market? What were the models doing? Renaissance never explained. Even investors who begged for access were told no. The fund's methods remained a black box. So what was Medallion's secret? Even today, decades later, the full details remain unknown. But certain principles are clear from interviews with Simons and former employees. First, Medallion's models were based on massive amounts of data. The algorithms analyzed price data going back centuries, in some cases to the 1700s. They looked at stocks, bonds, commodities, currencies, any liquid market. The goal was to identify small, repeatable patterns that provided a statistical edge. These patterns were not obvious. They were tiny anomalies, correlations that lasted hours or days before disappearing. Second, Medallion traded frequently. The average holding period was around 2 days. The fund was not buying companies to hold for years. It was exploiting short-term mispricings, buying when the model predicted an uptick, selling when it predicted a downtick. Over thousands of trades, small edges compounded into massive returns. Third, the models adapted constantly. Markets evolve. Patterns that worked yesterday may not work tomorrow. Renaissance researchers were always testing, refining, improving the algorithms. If a model stopped working, they discarded it and built a new one. The system was self-correcting. Fourth, Renaissance never overrode the models. This was perhaps Simons' most important rule. Human judgment was not allowed to interfere with algorithmic decisions. If the model said buy, they bought. If it said sell, they sold. Even when it felt wrong. Especially when it felt wrong. Most investors cannot do this. When markets crash and their models say buy, fear takes over. When markets soar and their models say sell, greed takes over. Renaissance researchers were trained to ignore those emotions. They were scientists, not gamblers. They trusted the data. Let me give you a sense of Medallion's performance. From 1988 to 2018, the fund generated an average annual return of 66.1% before fees. After the 44% performance fee and 5% management fee, investors still earned 39.1% annually. To put that in perspective, $1 invested in Medallion in 1988 would have grown to over $42,000 by 2018. $1 invested in the S&P 500 over the same period would have grown to around $20. Medallion outperformed the market by a factor of 2,000. Even more remarkably, Medallion had very few losing months. Between January 1993 and April 2005, the fund had only 17 losing months and only 3 losing quarters out of 49. This is not supposed to be possible. Markets are supposed to be efficient. Prices are supposed to reflect all available information. No one should be able to consistently beat the market by such enormous margins. Yet Medallion did. Year after year. Decade after decade. Of course, Renaissance was not perfect. In the mid-2000s, Simons launched funds designed to offer Medallion-style returns to outside investors. These funds, including the Renaissance Institutional Equities Fund, managed tens of billions in assets. But they struggled. The problem was scale. Medallion's strategy worked beautifully with small amounts of capital. It did not scale to 50 or 100 billion. The larger funds had positive returns, but nothing like Medallion's magic. Critics questioned whether Simons was overextending his secret sauce. Some wondered if Medallion itself was a fluke, a lucky run that would eventually crash. Then came 2008. The financial crisis. Lehman Brothers collapsed. The S&P 500 fell 38%. Panic swept global markets. Renaissance, like everyone else, faced extreme volatility. But while the market cratered, Medallion soared. The fund returned nearly 80% in 2008, almost doubling investors' money while the rest of the world bled. It was one of the great trading performances in history. How did Medallion make money in 2008 when almost everyone else lost? The models detected patterns in the chaos. When fear was maximum, prices were most dislocated from fundamental value. Medallion's algorithms bought assets others were desperately selling and sold assets others were desperately buying. The very panic that destroyed conventional investors created opportunities for a purely mathematical approach. 2008 cemented Simons' reputation. He was not lucky. His methods were not a gimmick. He had built a system that worked in any market condition. But Renaissance also faced challenges beyond performance. In 2014, the United States Senate Permanent Subcommittee on Investigations issued a bipartisan condemnation of Renaissance for using complex tax strategies. The firm had used basket options to shield day-to-day trading from ordinary income tax rates, treating short-term trades as long-term capital gains. Senator John McCain stated that Renaissance had avoided paying more than $6 billion in taxes over roughly a decade by disguising short-term trades as long-term investments. The New York Times reported that Renaissance was involved in one of the biggest tax battles of the year. Simons and his firm maintained they had done nothing illegal, that their strategies were approved by advisors and fell within existing tax law. But the controversy dragged on. In September 2021, it was announced that Simons and his colleagues would pay billions of dollars in back taxes, interest, and penalties to resolve the dispute. It was one of the biggest tax settlements in IRS history. Simons accepted the outcome without much public comment. He had always been more interested in mathematics than in defending his reputation. By then, he was focused on his next act: philanthropy. In 1994, Jim Simons and his wife Marilyn founded the Simons Foundation. The foundation's mission was to support research in mathematics and fundamental sciences. Over the next 3 decades, the foundation gave away billions of dollars. It became the top benefactor of Stony Brook University, Simons' alma mater MIT, and the University of California, Berkeley, where he earned his Ph.D. The foundation established the Simons Center for Geometry and Physics at Stony Brook. It created Math for America, an organization supporting mathematics and science teachers in New York. It funded the Simons Foundation Autism Research Initiative. It supported cutting-edge research in neuroscience, cosmology, biology, and computational science. In 2023, the Simons Foundation gave $500 million to Stony Brook University, the second largest donation to a public university in United States history. Simons' approach to philanthropy mirrored his approach to investing. Be disciplined. Support the best researchers. Trust the process. Do not micromanage. Let talented people pursue ambitious ideas. The Simons Foundation was not interested in safe, incremental projects. It funded high-risk, high-reward science that could change fundamental understanding. Simons believed science was humanity's greatest tool for solving problems. His wealth gave him the ability to accelerate scientific progress. Jim Simons also experienced profound personal tragedy. In 1996, his son Paul was killed while riding his bicycle on Long Island. He was 34 years old. In 2003, another son Nicholas drowned in Bali while doing volunteer work. He was 24. These losses devastated Simons and his wife. Friends say the tragedies profoundly shaped their philanthropic priorities. They wanted to honor their son's memories by doing work that would have made them proud. They established the Nick Simons Institute in Nepal to train medical workers in his name. They increased their giving to education and research. Money could not bring back their children, but it could improve lives and advance knowledge. Simons retired as Chief Executive Officer of Renaissance Technologies in 2010. He remained chairman until 2021. Even after stepping back from daily operations, he kept his personal wealth invested in Medallion. The fund continued performing spectacularly under the leadership of Peter Brown and Robert Mercer. By the time of Simons' death in May 2024, his net worth was estimated at $31.4 billion. He was the 55th richest person in the world. But Simons had given away far more than he kept. Estimates suggest he donated over $5 billion to various causes during his lifetime. His foundation continues operating with an endowment ensuring decades more funding. When asked how he wanted to be remembered, Simons gave a characteristically simple answer. I did a lot of math. I made a lot of money. And I gave almost all of it away. That is the story of my life. So what made Jim Simons different? What separated him from every other investor? Start with intellectual humility. Simons knew he did not have special insight into companies or economies. He did not believe he could predict the future better than anyone else. So he did not try. Instead, he admitted uncertainty and built systems to profit from probabilities. Unlike traditional investors who rely on conviction, Simons relied on math. Next, radical discipline. Most investors cannot follow their own rules. When fear spikes, they panic and sell. When greed surges, they chase hot stocks. Simons and his team never deviated from the models. If the algorithm said buy during a crash, they bought. This is psychologically brutal. It requires trusting mathematics more than instinct. Most humans cannot do it. Third, talent recruitment. Simons understood that in a data-driven business, the best minds win. He built Renaissance by recruiting the smartest mathematicians, physicists, and computer scientists he could find. He paid them generously, gave them challenging problems, and let them work collaboratively. The result was an intellectual culture unmatched in finance. Fourth, long-term thinking. Simons spent 10 years building models before Medallion took off. Most people would have given up. He understood that solving hard problems takes time. He was patient. He iterated. He learned from failures. When something did not work, he tried something else. Fifth, alignment of incentives. By closing Medallion to outsiders and requiring employees to invest their own wealth in the fund, Simons created perfect alignment. Everyone's personal fortune depended on the models working. There was no agency problem, no conflict between fund managers and investors. Finally, belief in science. Simons never wavered in his conviction that patterns exist in data. Even when others doubted, even when models struggled, he believed that mathematics would reveal truth. That belief, combined with relentless effort, produced results no one thought possible. Simons proved something profound about markets. They are not perfectly efficient. Patterns do exist. Mathematics can find those patterns. Human intuition is overrated. Systematic approaches beat discretionary trading. Discipline beats brilliance. This was revolutionary in the 1980s. Today, quantitative investing has become mainstream. Hundreds of hedge funds use algorithmic strategies. Computers execute millions of trades per second. Machine learning models analyze vast datasets. But even now, no one has matched Medallion's performance. Many have tried to replicate Renaissance's success and failed. Why? Because Simons did not just have good algorithms. He built an entire ecosystem. The talent, the culture, the secrecy, the long-term focus, the perfect incentives. All of it mattered. Remove any piece and the magic disappears. There is a deeper lesson in Simons' story. He succeeded precisely because he was not a traditional Wall Street person. His background in mathematics, code breaking, and academic research gave him a completely different lens for viewing markets. While others saw chaos and emotion, he saw data and patterns. While others trusted gut instinct, he trusted algorithms. While others competed with ego and bluster, he collaborated with humility and rigor. The greatest investor in history was not even trying to be an investor. He was trying to solve a mathematical puzzle. The billions were a side effect. Today, Renaissance Technologies continues operating. The firm manages over $74 billion in assets across multiple funds. The Medallion Fund remains closed to outsiders, still generating extraordinary returns for the few hundred employees and family members with access. Peter Brown and the leadership team maintain the culture Simons built. They hire mathematicians and physicists, not MBAs. They trust models over intuition. They protect their secrets fiercely. Researchers still sign non-disclosure agreements. The firm rarely speaks to media. The methods remain proprietary. Renaissance alumni have gone on to start other quantitative hedge funds. They carry forward the systematic, data-driven approach Simons pioneered. But none have matched Medallion. Simons' impact extends far beyond finance. His philanthropic work is accelerating scientific research across mathematics, physics, biology, neuroscience, and autism research. The Simons Foundation supports some of the most ambitious scientific projects in the world. Young scientists whose careers were launched by Simons Foundation grants are making discoveries that will shape the 21st century. He also transformed education. Math for America has trained thousands of teachers who inspire the next generation of scientists. His donations to MIT, Berkeley, and Stony Brook have built research facilities and funded scholarships that will benefit students for generations. In physics, the Chern-Simons theory he developed with Shuingshan Chern remains fundamental to string theory and quantum field theory. Physicists continue building on that mathematical framework. Simons' mathematical legacy would have been significant even if he had never entered finance. But he did enter finance and changed it forever. He showed that markets are data problems. He proved that mathematics beats intuition. He demonstrated that scientists can thrive on Wall Street if they bring the right mindset. When Chern-Simons died in May 2024, tributes poured in from across the scientific and financial worlds. Former colleagues remembered his brilliance and generosity. Scientists praised his philanthropic vision. Investors marveled at his unmatched track record. But perhaps the most fitting tribute came from the simple numbers. 66% annual returns for 30 years. $31 billion in net worth. Over $5 billion donated to science and education. These are not just impressive statistics. They represent a complete reimagining of what is possible when you apply scientific thinking to financial markets. They prove that the greatest advantages come not from insider information or charismatic personalities but from disciplined systems and collaborative genius. Think about what Simons accomplished. He started investing at age 40 with no finance background. He was a mathematician who had spent his career studying abstract geometric spaces. Yet within 10 years, he had built a system that would outperform every other investor for 3 decades. He did this by rejecting conventional wisdom. Wall Street said you needed business school training and years of experience analyzing companies. Simons hired physicists who had never taken a business class. Wall Street said successful investors needed conviction and the courage to trust their instincts. Simons removed human judgment entirely and trusted algorithms. Wall Street said you had to be in Manhattan, close to the action, networking with other traders. Simons built his operation on a quiet Long Island campus that looked like a college. Wall Street said the best traders were aggressive personalities who thrived on competition and risk. Simons created a collaborative culture where researchers worked together, shared ideas freely, and let data settle disputes. Every conventional rule, he broke. And he won bigger than anyone. There is something almost poetic about a mathematician solving markets. Financial markets are perhaps the most complex systems humans have created. Millions of participants making billions of decisions based on incomplete information, conflicting incentives, and emotional biases. Traditional investors try to understand this complexity through narratives. They study companies, interview management teams, analyze industries, and build stories about the future. Simons took the opposite approach. He said, forget the stories. Forget trying to understand why prices move. Just collect vast amounts of data and let mathematics find patterns. It is the difference between a novelist and a physicist. The novelist creates meaning through narrative. The physicist finds truth through data. Markets seem like they should favor novelists, people who understand human psychology and can predict how others will react. But Simons proved that the physicist approach works better, at least for short-term trading. The key insight was that markets are not perfectly efficient, but they are too complex for human brains to predict. Our pattern recognition is good but limited. We see faces in clouds and meaning in randomness. We are overconfident in our predictions and emotionally attached to our beliefs. Computers do not have these flaws. Algorithms can analyze millions of data points without bias or fatigue. They can detect correlations humans would never notice. They can execute thousands of trades without fear or greed. As long as the mathematical edge exists, the computer will exploit it systematically. Simons understood this before almost anyone. In the 1980s, while Wall Street was still dominated by old-fashioned stock pickers, he was building the future. By the 2000s, quantitative investing had become a major force. Today, algorithms execute the majority of trades. High-frequency trading firms use Simons' playbook. Machine learning models power investment strategies at major banks. The revolution Simons started has transformed global finance. But here is what is remarkable. Even though everyone knows Simons' approach works, even though hundreds of firms now use similar methods, no one has matched Medallion. Why not? Because Simons was not just early to quantitative investing. He was better at it. The talent he recruited was extraordinary. The culture he built was unique. The secrecy he maintained protected his edge. And the feedback loop he created, where the best researchers stayed at Renaissance, got rich from Medallion, and reinvested in improving the models, was self-reinforcing. It is a case study in sustainable competitive advantage. Simons found an edge, exploited it brilliantly, and protected it fiercely. Outsiders could copy the general approach but not the specific execution. They could hire smart people but not build the same culture. They could develop models but not maintain them as effectively. Renaissance became a black box that printed money year after year while everyone else watched and wondered. Let me address the question many people ask. Was Simons just lucky? Did he happen to find patterns that worked for 3 decades by chance? This is always a possibility in finance. Randomness can produce winning streaks. Survivorship bias means we only hear about the winners. Perhaps Renaissance was one of many firms trying similar approaches and happened to succeed while others failed quietly. But the evidence suggests skill, not luck. First, the consistency. Medallion did not have a few spectacular years surrounded by mediocrity. It beat the market almost every single year for 30 years. The probability of doing that by luck is astronomically small. Second, the 2008 performance. Making 80% returns during the worst financial crisis in generations, when nearly everyone else lost money, is not luck. It is having models that work precisely when markets are most chaotic. Third, the talent. Renaissance did not hire randomly. They recruited some of the smartest mathematicians and computer scientists in the world. These were people who had solved other extraordinarily difficult problems. It is unlikely they all got lucky simultaneously. Fourth, the secrecy. If Medallion returns were just luck, there would be no reason for such extreme confidentiality. The fact that Renaissance guarded its methods so carefully suggests those methods contained real, reproducible edge. That said, luck certainly played a role. Simons was lucky to live in an era when computing power was advancing rapidly, making algorithmic trading possible. He was lucky that markets had inefficiencies his models could exploit. He was lucky to avoid catastrophic technology failures or regulatory changes that could have destroyed his strategy. He was lucky to find and recruit extraordinary collaborators like James Axe, Robert Mercer, and Peter Brown. Luck always matters. But Simons maximized his luck. He positioned himself to benefit when opportunities arose. He built systems that could adapt when conditions changed. He created an organization that could continue succeeding even after he retired. That is not just luck. That is genius combined with discipline and vision. One of the most interesting aspects of Simons' story is what it reveals about the nature of investment skill. For decades, the debate in finance has been active versus passive investing. Active investors claim they can beat the market by picking undervalued stocks. Passive investors say markets are efficient, so just buy index funds. Simons represents a third category: systematic active investing. He was active in the sense that he was constantly making bets, trying to beat the market. But his approach was entirely systematic, based on mathematical models rather than human judgment. This hybrid approach has important implications. It suggests that human stock pickers are probably overrated. If Medallion can generate 66% returns without anyone understanding or predicting company fundamentals, maybe traditional fundamental analysis is not as valuable as we thought. But it also suggests that markets are not perfectly efficient. If they were, no amount of mathematical sophistication could generate consistent alpha. The patterns Renaissance exploited should not exist in efficient markets. So the truth is somewhere in the middle. Markets are mostly efficient but not perfectly so. Small inefficiencies exist, especially over short time horizons. Exploiting those inefficiencies requires extreme computational power, vast datasets, and brilliant algorithms. It also requires keeping your method secret so others do not copy them and eliminate the edge. For the average investor, the lesson is probably still to buy index funds. You cannot build what Simons built. You do not have access to his talent, his data, his models, or his culture. Trying to pick stocks based on intuition will almost certainly underperform. But for institutions, entrepreneurs, and researchers, the lesson is different. Bring scientific thinking to problems others approach intuitively. Build systems that remove human bias. Assemble teams of exceptional talent. Be patient. Protect your edges. Think in probabilities, not certainties. These principles apply far beyond investing. Simons' approach to problem solving is a template for tackling any complex system where patterns exist but are hidden. Consider his intellectual journey. He started as a pure mathematician, solving abstract problems with no practical application. Then he became a code breaker, using mathematics to find patterns in encrypted messages. Then he became an investor, using mathematics to find patterns in market data. The through line is pattern recognition through rigorous analysis. Whether the system is geometry, cryptography, or financial markets, the method is the same. Collect data. Build models. Test hypotheses. Refine based on results. Trust the process. This is the scientific method applied to money. And it worked spectacularly. It made Simons one of the richest people on earth. But wealth was never his primary goal. In interviews, he often seemed surprised by how much money he had made. He would joke that he liked making money but did not need $30 billion. What he really loved was solving problems. The intellectual challenge. The elegance of a well-designed system. The satisfaction of seeing mathematics triumph over intuition. This attitude is perhaps his greatest legacy. He showed that you do not have to conform to Wall Street culture to succeed in finance. You do not need an MBA or decades climbing corporate ladders. You do not need to shout on trading floors or schmooze at expensive dinners. You just need to be smarter than the market and disciplined enough to follow your own rules. Simons was soft-spoken, almost shy in social situations. He wore casual clothes and sneakers to work. He cared more about equations than earnings calls. He was, in other words, the opposite of the typical hedge fund billionaire. Yet he beat them all. There is a beautiful symmetry to his life. He started with pure mathematics, work that seemed disconnected from real-world applications. He ended with applied mathematics that generated more wealth than almost any practical pursuit. The Chern-Simons form he developed in the 1970s now underpin string theory. The algorithms he developed in the 1980s now generate billions annually. The philanthropic foundation he built ensures that future mathematicians and scientists will have resources to pursue knowledge for its own sake, just as he once did. He came full circle. From mathematics to wealth and back to mathematics. Now let us talk about what others can learn from Jim Simons, starting with lessons for aspiring investors. First, find your edge. Simons' edge was not business acumen or market intuition. It was mathematical pattern recognition. He leaned into his unique strength rather than trying to compete on others' terms. If you want to invest successfully, identify what you know or can do that others cannot. Your edge might be deep industry expertise, a unique network, superior discipline, or something else entirely. But you must have one. Without an edge, you are gambling, not investing. Second, remove emotion from decisions. The hardest part of investing is not finding good opportunities. It is having the discipline to stick with your strategy when markets panic or euphoria hits. Simon solved this by programming his strategy into algorithms. You might not be able to do that, but you can create rules for yourself and force yourself to follow them. Write down your investment criteria. When you buy, write down why and what would make you sell. Review regularly. Let evidence, not emotion, guide you. Third, play to your time horizon. Simon's strategy worked for short-term trading. It would not work for 5-year holding periods. Different strategies suit different time frames. If you are investing for retirement 30 years away, you do not need Simon's approach. Buy quality companies or index funds and let time do the work. If you are trading frequently, you need a system like Simons to overcome transaction costs. Match your strategy to your timeline. Fourth, be willing to be wrong and learn. Simon spent 10 years developing models before Medallion took off. many of those early models failed. He learned from failures, adjusted, and tried again. Most people give up after a few setbacks. Simons persisted because he believed the underlying approach was sound even when specific implementations failed. In investing and life, resilience matters more than being right initially. Fifth, know what you do not know. Simons freely admitted he did not understand individual companies well. So he did not try to pick stocks based on fundamental analysis. He played a different game entirely. Many investors fail because they overestimate their understanding. If you do not have genuine insight into a company, industry, or market, admit it and either develop that insight or invest elsewhere. Now, lessons for entrepreneurs and business builders. First, culture is everything. Simons built Renaissance on collaboration, intellectual honesty, and shared incentives. Everyone was aligned. Everyone was brilliant. Everyone checked their ego. That culture was as important as any algorithm. When building a company, obsess over who you hire and how they work together. Skills matter, but fit matters more. Second, incentives drive behavior. By making Renaissance employees invest their own wealth in Medallion and tying compensation to results, Simons ensured everyone acted in the firm's interest. Design your incentive structures carefully. Are employees motivated to do what is best for customers and the company long-term, or to maximize short-term metrics that make them look good? Third, protect your competitive advantages. Renaissance kept its methods secret for decades. It required non-disclosure agreements, non-compete clauses, and a culture of confidentiality. In a world where information spreads instantly, maintaining proprietary advantages is harder than ever but more valuable. If you discover something that works, protect it. Fourth, hire for intelligence and adaptability, not experience. Simons hired mathematicians with no finance background because he valued raw problem-solving ability over domain expertise. This is counterintuitive. Most companies hire for experience. But in rapidly changing fields, the ability to learn and adapt may be more valuable than knowing how things have been done. Fifth, be patient with hard problems. Simons spent a decade building his models. Most startups and most projects get abandoned long before 10 years. We live in an era of instant gratification and quarterly earnings. But truly difficult problems take time. If you are working on something genuinely hard, give it the time it needs. Now, lessons for life and career more broadly. First, follow your curiosity. Simons loved mathematics. He could have stayed in academia and lived comfortably. Instead, he followed his curiosity about markets and built something revolutionary. When you are genuinely interested in a problem, you will work harder, think more creatively, and persist longer than people who are just chasing money or status. Second, be willing to reinvent yourself. Simons had 3 distinct careers: academic mathematician, code breaker, investor. Each time he shifted, he brought insights from previous work. Do not feel locked into one path. Skills and knowledge are transferable. The mathematician became an investor. The code breaker became a philanthropist. You are not your job title. You are your capabilities and values. Third, use success to create more success. Once Medallion was profitable, Simons used the profits to hire better researchers, build better technology, and attract more talent. Success compounds. If you are fortunate enough to achieve early wins, reinvest them in becoming even better. Fourth, give back. Simons could have spent his billions on yachts, mansions, and luxury. Instead, he gave most of it away to advance science and education. He understood that beyond a certain point, money does not increase happiness, but it can increase your impact. If you are successful, think about how you can help others. Fifth, accept that tragedy is part of life. Simons lost 2 sons. Nothing could prepare anyone for that pain. But he channeled his grief into purpose, funding medical training in Nepal and supporting research that might prevent future suffering. Life will include profound loss. How you respond defines you. Simons responded with generosity and purpose. Let me also address what did not work about Simons' approach or where others should be cautious. First, the medallion strategy does not scale. When Renaissance tried to apply similar methods to larger funds open to outside investors, results were far less impressive. If you find something that works, recognize that scaling it may destroy what made it work. Sometimes staying small is better than growing large. Second, extreme secrecy has costs. Renaissance culture of confidentiality meant employees could not discuss their work with outsiders, even family. That is isolating. It also means the broader world did not benefit from Renaissance insights until much later. Secrecy protects advantages but limits your impact. Third, pure quantitative approaches can miss big picture changes. Simons' models were backward-looking, based on historical patterns. If the future is radically different from the past, those patterns may not hold. During major regime changes like the advent of the internet or cryptocurrencies, purely quantitative approaches may struggle. You need some qualitative judgment about whether the world is changing. Fourth, success can breed arrogance. Some Renaissance alumni went on to other ventures and assumed their medallion success would transfer. It often did not. Success in one domain does not guarantee success elsewhere. Stay humble. Fifth, legal and ethical boundaries can be murky. Renaissance tax strategies were aggressive. While the firm maintained they were legal, the IRS disagreed and Renaissance ultimately paid billions in back taxes. When pushing boundaries, be prepared for scrutiny and potential consequences. So what is Jim Simons' legacy? First, he revolutionized investing. Quantitative, algorithmic approaches are now mainstream. High-frequency trading, machine learning models, systematic strategies, all trace back to Simons' pioneering work. Second, he proved that scientists can thrive in finance. Before Simons, Wall Street was dominated by business school graduates and traditional bankers. Now, mathematics Ph.D.s and physicists are highly valued. He opened a door for a generation of technically trained people to enter finance. Third, he showed that radical transparency and collaboration can work. Most hedge funds are secretive and hierarchical. Renaissance was secretive externally but radically open internally. That combination of transparency within and secrecy without became a model others tried to replicate. Fourth, his philanthropy is accelerating science. The Simons Foundation is funding research that would not happen otherwise. Young scientists whose careers were launched by Simons grants will make discoveries for decades. His impact on mathematics, physics, and neuroscience will outlive him. Fifth, his life story is inspirational. He was not born wealthy. He did not have connections. He was a shy mathematician who could not remember where things were stored in a garden supply stockroom. Yet he built the most successful investment fund in history by staying true to his strengths and thinking differently. That is a powerful message. You do not have to fit the mold. You can succeed by being yourself and playing your own game. When I think about Jim Simons, I am struck by the contrast between his public persona and his impact. He gave few interviews. He avoided the spotlight. He dressed casually and spoke quietly. If you passed him on the street, you would not know he was a billionaire. Yet his influence is enormous. Renaissance Technologies manages over $70 billion. The Simons Foundation gives away hundreds of millions annually. Countless scientists, teachers, and students have been helped by his generosity. His mathematical work continues advancing physics. His investment methods transformed finance. He was, in the truest sense, a quiet giant. I am also struck by what his story says about human potential. Simons was brilliant, certainly, but the world is full of brilliant people who never accomplish a fraction of what he did. What set him apart was not raw intelligence. It was the combination of intelligence with discipline, humility, patience, and willingness to think differently. He trusted mathematics over intuition. He surrounded himself with people smarter than him and listened to them. He built systems and let them work. He persisted through failures. He kept learning and adapting. But the principles that guided him are accessible to all of us. Be disciplined. Build systems. Trust data over emotions. Surround yourself with excellence. Play to your strengths. Think long-term. Give back. These ideas are simple but profound. They work in investing and they work in life. As I close this story, I want to return to where we began. A 6-year-old boy doubling numbers in his head. 2, 4, 8, 16, 32, 64. That child grew up to become the most successful investor in history by recognizing a simple truth. Patterns exist. Mathematics can find them. Discipline can exploit them. From that insight came $30 billion, $5 billion in philanthropy, and a revolution in how we think about markets. Chern-Simons proved that the outsider can win. The mathematician can beat the Wall Street trader. The scientist can outperform the businessman. The quiet genius can triumph over the loud braggart. He did it with elegance, humility, and rigor. He played a different game and won bigger than anyone. And perhaps most importantly, he used his winnings to advance human knowledge. The boy who wondered about infinity grew up to expand the boundaries of what we know. That is a life well lived. That is a legacy that endures. So the next time someone tells you markets are efficient and cannot be beaten, remember Chern-Simons. The next time someone says you need a business degree to succeed in finance, remember Chern-Simons. The next time someone says follow your passion even if it seems impractical, remember Chern-Simons. He loved mathematics. He trusted data. He built systems. He changed the world. 66% annual returns for 30 years. $100 billion generated. $5 billion donated to science. 3 decades of proving the impossible was possible. That is the story of Chern-Simons. The mathematician who sold the market.